video. So if you're still on Unit 1, you should not be watching this video. So far, we've talked about business cycles. We talked about how different pieces of macro data change during different phases of the business cycle. And now we're going to start to break down these one at a time. And this one's about gross domestic product and other national income accounting measures. We're going to be working on the first practice problem of Unit 2 as part of that. There's a table that's also included in the email. And again, if you've not started Unit 2 yet, you shouldn't be watching this video. Wait until Unit 2 to get the stuff here. So we're going to go ahead and we're going to start sharing the screen again. So just give me one moment here. Yes, there's a tunnel effect. It is what it is. But I'm going to start by, first of all, going back to our PowerPoint slideshow. And we're going to talk a little bit about some definitions and formulas, first of all. National income accounting. There's a number of different ways that we can measure different types of economic activity, and the national income accounting measures are one of them. It doesn't just measure income, it measures total spending to some degree, it measures total production as well, and these have a lot of uses here. And the most important one out of all of them is the one that was mentioned in the business cycle slideshow, and that's GDP, which stands for Gross Domestic Product. Gross domestic product is defined as the total market value. Remember Unit 1, supply, demand, equilibrium, price. In other words, get all the prices of all these things here and add them up. Of all final goods and services. Final goods and services are goods and services that require no further manufacturing. They are ready to consume now. They're in the end-use form. This also includes finished capital resources you see here. These are examples like restaurant equipment and fleet vehicles that are ready for businesses to use that are produced within the nation's geographic territory during a given year. Now, there's some other items I could mention, but the thing is, they're not listed in the definition. I didn't mention raw materials, for example. I did not mention a concept called intermediate goods, which are products that require further fashioning before they're in the end-use format. Raw materials would include stuff like ore that's taken out of a mine that you're used to make metal from, and the actual metal that's been smelted from the ore, like say aluminum, for example, or iron, is an intermediate good, or it's more likely to be called a capital resource. But that iron is going to be fashioned into parts, it's going to be fashioned into steel, which are going to be then put together to make vehicles or appliances and so forth, same with the aluminum, prior to them being ready to consume. Now, the reason why we don't include raw materials and we don't include intermediate goods or intermediate capital resources is because the price of a final good or service includes their value. The cost of the raw material, the cost of the intermediate fashion product, the cost of the final good incorporates all those costs and all that value added at each stage of production. So if we included raw materials or intermediate goods, they would be double or triple counted, and it would way overstate the actual value of the production or income inside the country here. Now, please notice it says within the geographic territory. We have national boundaries. If it's inside the lines, it's counted. If it's outside the lines, it's not counted. But notice there's no talk of national affiliation. If the income or production happens on U.S. soil, whether it's by an American citizen or a foreign citizen, whether it's by an American-based company or a foreign-based company, if it's inside the lines, it counts. Please keep in mind that a lot of American companies have operations outside the United States. The major car manufacturers and Boeing aircraft have got automobile and aircraft plants in Canada and Mexico, among other places. But the value of the production they do outside the country is not part of gross domestic product. It has nothing to do with what's happening inside the country. Similarly, if we didn't count, like, say, several foreign companies like Hyundai, for example, Kia, Toyota, Mitsubishi, Honda, BMW, they all have automobile plants on U.S. soil. And if we didn't count the production that they were doing on U.S. soil, it would be understating things. And plus, a lot of those factories employ American workers. So the bottom line is GDP is measuring the total market value of all of these final goods and services and finished capital resources that are produced on U.S. soil inside the borders during a given year. It is actually a piece of time series data. In fact, all of our, or the majority of our macro data, are time series data, means they're measured for a specific point in time, like a specific year, for example. And every year we have to recalculate everything because the data is different from one year to the next. Now, the formula for gross domestic product is fairly straightforward. It's addition and subtraction, but we're dealing with thousands of billions, aka trillions in US English, of US dollars. And then basically there's a short formula with some alphabet soup, but we're not going to be using those symbols. We're going to be using the full words in our table. Consumer spending. This is spending by U.S. households on domestically produced final goods and services, and these are U.S. households on U.S. soil. Consumer spending is strictly a domestic part of gross domestic product. The next part is gross private domestic investment spending. This is spending by businesses on finished capital resources, spending by businesses on maintaining finished capital resources that were bought in the past. We call that capital consumption allowance or depreciation. And it also includes the net change in retail inventory, because merchandise on the shelves in a store is considered capital until somebody buys it and uses it personally, at which point it becomes a good. So that's all the spending by businesses on the finished capital resources that year, maintaining old resources that are finished capital bought in the past, and the net change in the retailer inventory. This is strictly domestic. And then third part is government spending. This is spending by the federal government on finished capital resources and final goods and services that are produced domestically. Please note, consumer spending, gross private investment spending, and government spending are strictly on domestically produced final goods and services and finished capital resources. There's no imports in the consumer spending, the gross private domestic investment spending, nor the government spending. It's strictly the domestic parts. All the imports are over here. We'll get to that in just a second. We add exports. These are products that are produced domestically that are then sent to other countries. Notice the exports are added because money is coming in while goods and services and finished capital resources are leaving. It's like an injection of spending to our economy. Then here are the imports. This is the spending by households, businesses, and government agencies on finished capital resources, final goods and services that are produced outside the United States. In other words, goods and services are coming in, but money is leaving and it's treated as a leakage. That's why it's subtracted. So you add the first four numbers, subtract the last. That is your gross domestic product. Now, I'm going to go ahead and go over to the practice problem set. And one of the things you're going to be doing here, and this is on homework 2, problem 1, this will also be on your unit 2 test, is you've got a table with a bunch of different data here for a particular calendar year. Not all the data is going to be used in the formulas. Some of it's just extra data that's not needed. This is an accounting problem. If you've had accounting, you know that sometimes you're given a bunch of data and you have to sort out what you need and don't use what you don't to do the calculations that are necessary. Notice everything in this table, with the exception of the Consumer Price Index or CPI, is stated in billions of US dollars to the nearest single decimal place. In other words, nearest $100 million. Quick comment about formatting. Never drop your formatting when you work these formulas. It has to always be in the same format the data is provided. So even if you got a 0 in that decimal place, it's got to be there because it has to deal with level of accuracy and significant digits. We know this to the nearest $100 million. We don't know it past that. And so knowing there's a 0 in that place is also telling the person who reads it, there's other decimals after that 0. We just don't know what it is. And so we have to make sure we watch our formatting here. And it says all figures expressed to one decimal place. That's just to reinforce this. Now, you'll notice here that this data happens to be in alphabetical order. And so right now it's a matter of hunting up the consumer spending, the gross private domestic investment spending, the government spending, the exports, and the imports. The thing is, I could put this in any order I wanted to. Sometimes it's largest to smallest or smallest to largest. Sometimes it's alphabetical or reverse alphabetical order. Sometimes it's random. If you know the formulas, you'll just basically be able to hunt them up. Now, the table that y'all are provided here is an accounting table here. And what you'll be doing is using a pencil in most cases to fill in this data, with one exception. There's one piece of data that we've not worked with yet that may be negative cash. I'll talk about that when we get here. So the thing is, you'll notice the left-hand column has what the entry is. In accounting, when you're doing a table, you have to indicate what each line item is. And so the thing is, what's very convenient for me is that I have already put this data in here, and I'm going to reveal it to y'all. And all this data was culled from that table. Consumer spending, $8,214.3 billion. Gross private domestic investment spending, $1,928.1 billion. Government spending, $2,215.9 billion. Exports, $1,173.8 billion. And imports, $1,797.8 billion. Now notice all of our operators are here except for the first line item. Whenever you're doing this kind of accounting, use your original first value, doesn't have a plus or a minus sign, but the plus and minus sign do not denote positivity or negativity when you're working with money. No, no, no. It means either add this number to the previous entry or subtract this number from the previous entry. So what we do is we add the first four numbers together, and then we subtract the last number. And if you do the math correctly, you get $11,734.3 billion. This was the gross domestic product for 2004 based upon the table's data. This is not hard arithmetic. It's just that the thing is, when you fill in these tables, all these values here, you should use a gray pencil just in case you make a mistake. And you just run the numbers through the calculator. The arithmetic is easy. It's adding and subtracting, but you have to format the numbers. Now notice when we get to an answer, we don't have a plus or a minus sign. We have an equal sign, and this is expected. Don't format the numbers. Like if you forget the word billion, you're going to lose points for not formatting. Forget the dollar sign, you're going to lose points for not formatting. Forget the operators, addition or subtraction, you'll lose points for not following the proper format. Attention to detail is key. Now, there's a debate among some economists about which measure is better, gross domestic or net domestic product, and some economists don't like gross domestic product as much as I do. They prefer to use net domestic product. And so the definition for net domestic product is the total market value of all of the brand new final goods and services and the brand new finished capital resources that are produced within a nation's borders during a given year. Geographic territory, I say here. Now, what's different between this and the gross domestic product is it doesn't include what some accountants like to call depreciation, but economists would call capital consumption allowance or consumption of fixed capital in some textbooks. Folks, a building that was built 5 years ago is going to require maintenance. You may have to replace some of the plumbing. You may have to fix the elevator and put some new parts in there a few times. You're going to have to hire some repair services. Finished capital resources or finished final goods and services bought in the past will require maintenance. And so the thing is here, it's like all that spending on the maintaining the old finished capital resources bought in the past is not really new production, and therefore really sometimes overstates things in some economists' eyes. And so they want to toss out all the depreciation expenses, all the depreciation spending, and just look at the brand new final goods and services and brand new finished capital resources. Now the formula, we're going to go back to our table here, says you start with gross domestic product. I want you to notice that each result feeds in the next formula. You start with the gross domestic product, and then you subtract the capital consumption allowance. Again, you go back to your original table. That's where all this data is coming from. This is the Unit 2 Practice Problem 1. You subtract $1,435.3 billion. Now, the word billion will carry down. The minus means subtract. This is a positive number subtracted from another positive number. That's why it's in black. And then you do the calculation, and this is what it should say when you're done. $10,299.0 billion. Please notice that 0.0. That is important, y'all. If you don't put that 0.0, you have violated the rule of significant digits here. There are decimals after that first decimal place that are unknown. Remember, 1/10 of $1 billion is $100 million, and that is our level of accuracy. And to change your decimal place numbers would violate that. So I want you to notice that in 2004, we spent almost, $1,400, a little bit more than $1,400 billion on maintaining old capital and old goods bought in the past here. And so this here, to some people, is a better measure. I think each of them have a good validity for different reasons. If you've got two countries with almost equal GDPs and one has a much higher net domestic product than the other, you could infer that the one with a higher net domestic product has a lot of newer capital resources because new vehicles and new buildings don't break down as much as old ones do. And it might indicate some kind of qualitative assumption you can make about that country. Poland and the Czech Republic have similar gross domestic products, but the Czech Republic has a much higher net domestic product, whereas Poland's is much lower. And that typically indicates a little bit lower quality of life or lower quality of capital and equipment. Now, these next few, we're just going to go through and calculate. And we're going to talk national income is oftentimes considered like a direct production of final goods and services, but I need to talk about this factor here first, the net foreign income adjustment. The net foreign income adjustment has to deal with the fact that when we measure gross domestic product, we do this based upon location. But when people and businesses pay taxes, it has to deal with where have they officially headquartered their company. You see, corporate income taxes are based upon official headquarters. Foreign companies operating on U.S. soil don't really pay the same level of taxes that American companies operating on American soils will do. And American companies on foreign soil, same thing. They pay much lower taxes than the foreign companies would in their home country. Similarly, we've got foreign citizens who aren't immigrating, who earn income, and we've got American citizens who live outside the U.S. who earn income. And so we have to correct for this geography versus citizenship. And that's what the net foreign income adjustment is about. This value could be negative. It could be positive. And so let's talk about how we handle that. For 2004, ladies and gentlemen, this was the values for the factor income payments made to the foreign-based entities. This represents income earned by foreign businesses on U.S. soil, as well as foreign citizens. The next item says factor income receipts held by foreign-based entities. That's income earned by American people and businesses on foreign soil. Now you'll notice we're subtracting a bigger number from a smaller number, which means this is going to be negative, but let's talk about how we format negative cash here. And let me make sure that equal sign is not red. The red ink around parentheses is specifically reserved for the negative cash. Now the round parentheses are people that are red-green colorblind because they need to be able to see that this thing doesn't look like the typical cash value. These two values up here are both in black ink because they're both positive values. You're subtracting one positive value from another. But the thing is, since we have a negative difference between the two of them, you have to have red round parentheses on the outside and no minus sign. The minus sign does not denote negativity when you work with money. The minus sign merely means subtraction when you work with money. When you have a negative value when it comes to money, and I mean only money, only currency, red ink round parentheses is how you do. So this red ink round parentheses, $53.7 billion, means it's a negative $53.7 billion. Now this value gets used in two formulas. Notice it is used in the gross national product calculation, which we'll do at the end. But notice it is also used over here when we are calculating the national income. Now, what I always say is the national income, think of it as the income earned from direct production of final goods and services by a nation's affiliates, which means businesses headquartered in the country and citizens. So you start with the net domestic product, you subtract the indirect business taxes, and subtract the net foreign income adjustment. Watch out here. If net foreign income adjustment is negative, and let's be clear, it's not always negative every year. Some years it's positive. But since it's negative in this particular year, when you subtract a negative number, the math rule says you must add it as a positive number. So when you run these numbers through your calculators here, and don't just take my word for it, run it through, you get $9,378.4 billion for the national income. I want y'all to notice that with each calculation, we're getting a bit of a narrower measurement of production or income for the country. Now, this next adjustment here from national to personal income. Think of personal income as the total adjusted gross income of all U.S. affiliated households during a given year. Notice not businesses anymore, households. In other words, like people's salaries and wages, people's government benefits they may have gotten, any entrepreneurs' profits they paid to themselves, any dividends paid to stockholders that are personal as opposed to corporate. That's what this does. And so we have to start off by subtracting two values that represent corporate profits. Corporate profits are divided into three parts. The first part is corporate income taxes. That's the government share of corporate profits. I mentioned this before in class, but if a corporation posts an economic loss, there is no income to tax. A corporation has to post an economic profit for there to be taxable income. But this is the government share. Now, the retained earnings are sometimes called undistributed corporate profits. These are the profits the corporation keeps for itself. A corporation is not a human being. It is a business entity. And so these profits are plowed back into the company, if you will, for future benefit. It doesn't go to a person. It remains in a corporation. So we're deducting all that. Now, of course, the FICA taxes, we talked about income redistributions. That's the Social Security contributions we're talking about. This is all of the FICA taxes taken out of the wage earners that were used to fund the next item here, which is transfer payments. And notice the transfer payments are added in here. And so we got three items subtracted, one added. A little bit of advice on calculator input. Hit the equal sign after every operation, because sometimes if you do too many subtractions in a row, the calculator will carry the negative sign into the added part. You should see the values drop 3 times and then rise up again at the very end. You run these values for 2004 through, subtracting the first 3 values and adding the last one, you get $9,022.5 billion for the 2004 personal income. Now remember, you don't get to keep all your income. There's not just FICA taxes. There are also income taxes withheld by the federal government, and that's what personal taxes are referring to. Some states also take out state income tax. So if you want the actual take-home pay of U.S. affiliated households, you start with personal income, subtract personal taxes, and that equals disposable personal income. That doesn't mean income thrown in the trash, y'all. It means the actual income people and households get to spend. And so we run those numbers through. And then for 2004, that was $7,973.4 billion. Now, this is kind of interesting. $7,973.4 billion in take-home pay. But then look up here, we got $8,214.3 billion spent. I want you all to notice that U.S. households are spending about $250 billion more than they actually had in take-home pay. Now, how can people do that? Let's think about that for a moment. Well, one possibility is borrowing, taking out loans or credit cards. What's another? People could be selling stuff they bought in the past at a garage sale or on eBay or something. That's true. What's another possibility? That's correct. Unreported cash income. It could be somebody's doing something illegal, or maybe they're working a business, but they're doing it under the table and they're not reporting the taxes. It's a possibility. There's one more. They could be taking money out of savings. So that $250 billion differential between consumer spending and disposable personal income is taken up by those items: unreported cash income, borrowing, okay, taking money out of savings, and so forth. All righty. Now let's talk about this last item here for a moment. We already calculated our gross domestic product earlier as $11,734.3 billion, and it says to subtract the net foreign income adjustment. So be careful here. Remember, net foreign income adjustment in 04, we just calculated a little while ago, is negative $53.7 billion. Notice the minus sign ain't negative. It's a subtraction operator. But the net foreign income adjustment was negative for this year. You add that as a positive. And so when you do that operation, the end result is $11,788.0 billion. That is the final answer, if you will, the final answer for gross national product. And some people say, well, what exactly is gross national product? Well, the gross national product, let's go back to our slideshow. Okay, it used to be what we would consider our measure for national income accounting. Okay, gross national product is defined as the total market value of all final goods and services and finished capital resources produced by a nation's affiliates during a given year. Class, what this means here is we're looking at U.S. citizens and American-based businesses, all the income and production of final goods and services, all the spending and income they get from this anywhere on the planet, but it's only citizens and businesses affiliated or headquartered in the United States. That means foreign nationals and foreign businesses on U.S. soil don't count, but it also means U.S. business operations overseas and the activities of U.S. citizens overseas are counted. I mean, they're both measuring something similar. Total market value of final goods and services and finished capital resources that are produced, that are spent on, okay? But the difference is who is doing the spending, who is doing the production. By the way, I neglected to mention this earlier here, but the formula we have for gross domestic product, since it's all based upon spending on final goods and services and finished capital resources, is often called the aggregate expenditures, model. And aggregate expenditures means total spending. Now, where did we hear this before? Oh yeah, the root cause of business cycles. On that particular topic, I said that total spending is the theme of macroeconomics, and we've already heard it twice. Root cause of business cycles, changes in total spending. How do we calculate gross domestic product? We add up and do total spending. Bada bing, bada bang, bada bong. Okay, so I'm gonna stop sharing and just kind of wrap this sucker up here. Calculating national income accounts is not difficult as far as the arithmetic is concerned, especially with the use of a calculator. What y'all need to pay attention to is formatting and checking for accuracy. That matters a lot. So I wish you all success on this topic here. It's maybe not the most interesting one, but just understand something. When we measure our level of economic activity, gross domestic product is a favored measure of this. Have a good day, everybody, and thank you all very much.